Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the world's most popular cereal producer a good investment? You might be surprised by the answer. In this video we will be analyzing if Kellanova stock is a buy. Could Kellanova, stock ticker symbol K, be the next big mover in the stock market? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Kellanova. Kellanova was founded in 1894, giving the company over 130 years of experience in the food business. Kellanova focuses on a variety of food categories, including global snacking with iconic brands like Pringles and Cheez-Its, international breakfast favorites like Pop-Tarts and Cocoa Pops, North American frozen breakfast foods like Eggo waffles, and plant-based options under the Morningstar Farms banner. Today, Kellanova is headquartered in Chicago, Illinois and sells products in over 180 countries worldwide. Now let's look at the price action. Starting with the 1-year chart, we see that Kellanova had a CAGR of about -14%. Zooming out to the 5-year chart, we see that Kellanova had a CAGR of 0%. Kellanova share price has been under pressure lately and has not grown in 5 years. If we perform a backtest comparison of investing $10,000 in Kellanova versus the S&P 500, we find some interesting results for Kellanova. In that comparison with the S&P 500, $10,000 invested in Kellanova would have grown to just $12,485 or a 4% CAGR versus $22,073 or an 17% CAGR if invested in the S&P 500. This demonstrates tremendous underperformance for Kellanova. A Kellanova investment would have been less volatile with a 17% standard deviation versus 18% for the S&P 500. Kellanova underperformed the S&P 500 in terms of the best year performance, for which Kellanova actually grew 26% versus S&P 500 31% gain, but outperformed the worst year performance where Kellanova fell 13% versus the S&P 500 18% fall. In terms of max drawdown, Kellanova fell 28% compared with the max drawdown of 24% for the S&P 500. And surprisingly, Kellanova did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Clearly Kellanova has some downside protection as compared with the S&P 500, but the lack of share price appreciation outweighs any such benefit. Now let's hop over to market share and take a look at Kellanova's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that Kellanova is categorized under packaged foods. Expanding the packaged foods tab, we can see that Kellanova is the 4th largest packaged food company by revenue and is rapidly losing market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Kellanova, K, and see that the market share is 1.38% out of the publicly traded food, beverage, and restaurant stocks currently in the market. However, Kellanova is losing market share. The 5-year market share CAGR for Kellanova is -7.5%. If we start in 2019, we see that the market share was 1.88%, 1.92% in 2020, 1.41% in 2021, 1.37% in 2022, and rose to 1.38% over the trailing 12 months. In this version of market share, we can also Kellanova to a peer company such as General Mills to get a better understanding of the market's dynamics. Here we see that Kellanova is the smaller of the two companies, with Kellanova generating just under 40% of the revenue from a combined basket of the two companies. More worrisome is that Kellanova is actually losing market share relative to General Mills. This means that Kellanova is losing market share on both a relative basis when compared with a peer packaged food company and on an absolute basis. This is very bad. Let's take a look at the fundamentals. Gross margin is 33%. This is similar to other packaged food companies. Revenue has compounded at around -1% over the past 5 years and has reached over $13.1 billion most recently. Kellanova's revenue has fallen, but it looks to have bottomed in 2021. This may indicate a growth comeback. Looking at cash flow, we see a 9% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 4% CAGR. As a result, free cash flow has grown at a 13% CAGR. With operating cash flow is growing faster than capex, free cash flow growth is all but assured. This is good news. Weighted average shares outstanding have risen over the last 5 years, going from 342.9 million shares in 2019 to 344.6 million shares most recently. Kellanova has been slowly diluting shareholders. Given that the company produces so much free cash flow, I would have expected to see share buybacks. Seeing shareholder dilution at the company is very disappointing. Now let's view return on invested capital. Return on invested capital has fallen from 7.7% in 2019 to 6.8% in 2023. This is not good. Kellanova has gotten less efficient in managing the business. This is bad. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -13 days in 2019 to -14 days most recently, Kellanova has gotten a slightly more efficient over time. After reviewing so many food companies, it seems that large legacy companies manage to have negative cash conversion cycle values due to their favorable supplier and sales agreements. I believe that the negative cash conversion cycle values point towards strong brand value. Next, let's look at Kellanova's debt. The net debt to EBITDA has fallen just slightly over the past 5 years, going from 3.9 in 2019 to 3.4 most recently. While this debt load is not particularly high, it could mean trouble ahead if revenue continues to decline. Last, let's explore dividends. Current dividend yield is a hearty 4.05% with a dividend payout percentage of 103.3%. Kellanova is paying out dividends that its earnings cannot support. This indicates that the company's dividend practice is at high risk of being unsustainable. Dividends per share for this company have grown at a 1.2% dividend per share CAGR over the past 5 years and a 2.7% dividend per share CAGR over the past 10 years. Kellanova's dividend history looks very unhealthy and dividend growth appears to have stalled. The fundamentals of Kellanova are not good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. We are on track to hit 1000 subscribers this year, so thank you for watching and consider subscribing if you have not yet done so. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Kellanova. It is a food company with a gross margin of 33%. The 5-year revenue per share CAGR is -1% and the 5-year free cash flow per share CAGR is 13%. While the gross margin is decent and the free cash flow growth robust, revenue growth is in trouble. A return on invested capital of 7% is very low but looks to be trending upwards. Next, the cash conversion cycle of -14 days is good and points to its predecessor, Kellogg, having staying power over the years. Concerning debt, a net debt to EBITDA of 3.4 means that it will take Kellanova nearly 3.5 years of earnings to pay down their debt. Now let's switch our attention over to valuation. Kellanova is undervalued relative to the S&P 500 with a ratio of 0.9. The price to earnings growth, or PEG ratio, is 2.6, indicating that Kellanova is overvalued relative to projected earnings growth. Kellanova continues to be a large free cash flow producer, but both market share and revenue are on decline. Clearly, Kellanova is in the cash cow phase of its business cycle. This is also reflected in the valuations, with Kellanova being undervalued compared with the S&P 500 but overvalued in terms of predicted growth. Adding to this stagnation is the extremely high dividend payout ratio. Currently, the dividend payout ratio is more than 100%, which means that Kellanova is paying out more in dividends per year than the net income the company is generating. You don't have to be a mathematician to understand that such a practice is not sustainable. For cash cow companies like Kellanova, debt is usually the tool these companies employ to continue paying dividends. I expect all of these trends to continue. While such a company is not enticing to me, cash cow companies do play a beneficial role in some portfolios. Kellanova can offer some downside protection compared to the tech-heavy S&P 500, and can also decrease portfolio volatility. For me, these are not attributes I am looking for, and so Kellanova is not going on the watch list. Many thanks for watching. What do you think about Kellanova and their cash cow status? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.